Hello Gr10s, welcome. We are going to go through all the concepts that we covered this term. So we're going to look at all your journals, we're going to look at transactions, we're going to look at how to analyze those transactions, we're going to look at the cycle, the full accounting cycle, what happens first, where will we record the things firstly, where will we post most of these transactions to. We're going to look at all the different type of an accounts as well. What accounts do we have? We have assets and we have liabilities, we have capital and drawings and income and expenses. We're going to focus on all of the stuff that we covered in the first term. Now, let's quickly jump in and look at, again, the GARP principles. Can you still remember the GARP principles? Now, remember the GARP principles. What does GARP stand for? Generally Accepted Accounting Principles. And all financial records needs to be drawn up with these GARP principles in mind. Now, why should all sole traders use the GARP principles? Again, how do we compare one sole trader's financial statements to the other if they use different rules, different formats? How can we compare the two businesses? How can we see that business A is maybe a better investment than business B? How will we know what the cost prices of, say, our assets are if we don't have a certain rule we use when we record the purchase of assets or when we have income and expenses during a year? How do we record all these things? Now, I would like to give you quickly 3 minutes to copy down all 6 GARP principles for me. Good luck. Okay, guys, I hope you got all 6 of them. Now, let's look at the answer. Okay, so the answers are, just want to quickly open this for you, is the historical cost, is prudence, the matching principle, the materiality, going concern, and business entity. Now, I want to quickly go through all 6 of them. Remember, the very first one, historical cost. What does that say? All sole traders need to record the cost price of all assets purchased. So if they buy land and buildings, equipment, or vehicles, doesn't matter when they buy it, they record it in the books of the business at the historical cost price. So if you bought an old cell phone 5 years ago and you still have it and you paid 5,000 Rand for this phone, you need to record it at 5,000 Rand. That's the historical cost. Now, prudence, very nice and easy. You need to be conservative when you draw up any statements within a business. Now remember, if 10,000 Rands worth of stock is gone and lost, we can't keep it within the business's books. We need to get rid of it. We need to take it out and say we lost it. So we are being very pessimistic, but that's what we need to do. We can't say we have something if we can't track it in the business. The next one was the matching. Now remember the matching principle. We need to match all income and expenses to a certain period, normally a financial year, and therefore I don't care about when I pay or when I receive money. I care about when did this expense happen? When did we incur this expense? Will it be in this year or only next year? Same with income. Now the next one, the materiality one. Very nice and easy materiality. I want to keep certain things separate. I want to highlight certain things in the statement. Now, what do I want to see? Let's take a school, for example. A school uses a lot of stationery, but with stationery, they will use a lot of paper and ink. So what I can do in the school setup, I can use and create a T account called paper and ink. And then I can also have a T account called stationery. Therefore, I can see exactly what money is spent on ink and paper and what money is spent on stationery, because this is quite material for any school. Now if you're a small one-man show, you don't use a lot of stationery or paper or ink, you can just create one small account called maybe sundry expenses, include all expenses like your stationery and paper and inks in sundry expenses, because it's not a very big expense, so it's not very material to this company or business. The next one, going concern. Now, what is going concern? When I am busy with the books of a business, I will show that this business will continue in the near future. We're not selling it. We're not getting rid of it. It won't close down. So when we record transactions, we record it with the mindset that this business will continue. And then very lastly, your business entity. And that word drawings comes to mind. So when the owner takes anything or pays anything through the business, we need to record it as drawings. And this is because of our business entity rule. Let's go further. Now I have a nice table for you here. So we have 3 main things in accounting. We have your assets, we have owner's equity, and we have liabilities. Now, you can see that my table is a little bit incomplete and I hid a few things. So let's go and see what I would like you to quickly go and do. I would like you to complete this table. Firstly, I'm going to give you a minute to complete all the items under fixed assets. So here under fixed assets, you need to do that. The 2 main owner's equity accounts, but now remember, not your expenses and income, the other 2. And then quickly list any 2 non-current liabilities. Guys, I'm giving you 1 minute to do that. Okay, grade 10s, let's go and look at your answers. Hope you have all of them right. Let's start with the assets on the left-hand side. Your assets will be land and buildings, vehicles, equipment, and a fixed deposit. Now remember, a fixed deposit is when I have extra cash, I invest it into a fixed deposit like a 5-year deposit or a 3-year deposit, so therefore I'll get interest on it. Let's go on to owner's equity. Remember, we have your expenses income, but we also have capital and drawings. But now your non-current liabilities. Very nice, a mortgage bond. That will be your loan on land and buildings, and then we have a loan from the bank. Now, I would like to quickly go and see if you can understand and remember what current assets, current liabilities we have, and what income and expenses we have. So I'm going to give you 1 minute to quickly complete the rest of this table. Okay, guys, let's look at it. So our current assets, we have, just open it quickly. I see it's not opening. So your current assets will be your trading stock, it will be debtors, it will be creditors. Just want to open it for you. Let's quickly unlock it. There it is, trading stock. We have debtors control, bank, when it's a debit balance, we have cash floats, and we have petty cash. As you can see, that's all our current assets. Let's go to the opposite, your current liabilities. It will be your bank overdraft when it's a negative balance. And I see it's not opening, but take it down. Your current assets will be your creditors control and your bank overdraft. Now, what income and expenses will we have? Let's take it down in that column. It will be your expenses. Firstly, you have cost of sales. You'll have wages, salaries, stationery, packing material, consumables, bank charges, interest on loan. You'll have interest on any items like interest on overdraft. We can have many, many more like fuel and license fees and advertising and insurance and repairs and maintenance. So all that you need to know is whenever I pay something and I can't resell it to someone. So I buy a box of pens, I use the pens. Can I resell a half-empty pen? Not really. So I'm going to use it. I'm going to consume it within the business. Now, what incomes do I have? Different incomes you'll have will be your sales, your commission income, your fee income, your interest on current account. That is when you have a positive bank balance. You will have many other incomes, interest on fixed deposit, but know that when we receive anything or we win, like we have a discount received, for example, we are not paying as much as we should, and that will be regarded as an income. But let's continue now. I want to close off and let's look at if you can still remember the accounting equation. So I want to give you 30 seconds to quickly write down the equation for me, and then we'll continue. Okay guys, so actually the answer was shown on the previous slide. Let's go and see if you can still remember it. Your assets equals owner's equity plus liabilities. Now you need to remember this equation. This is the first pillar of accounting. If you know this, you can't go wrong with anything you attempt in accounting. So I'll see you after the break and we'll continue. Okay guys, so let's look again at all the different T accounts. Now remember, T accounts, when we look at T accounts, don't get stressed. It's very easy. We normally have a month, then a day, then details. Now that details is a contra account. We can't just use any wording. The wording we should use is any of the other T account names, unless, for example, in bank, we have total receipts and total payments, or in creditors control when I have sundry purchases and sundry returns. The rest will all be a specific T account name, so that will be your details. And wherever you get the info from, so whatever journal we use to get the amount and then transfer to the ledger, that will be your folio, and then you just use the amount that you calculated in the journal. For me, very important, you need to know what type of an account do we have, where will it increase, and where will it decrease, and then if it increases or decreases, what happens to owner's equity when that T account goes up or down. So let's go and look at a few examples. Now again, firstly, your assets will always equal owner's equity plus liabilities. Now firstly, we're going to look at your assets. Now remember, assets are stuff that I own. It's belongings that the business have. They will have these things and own it, and all assets will be plus minus. So it doesn't matter if it's a current asset or a non-current asset, like a land and building, or bank or debtors, all of them will go up on the debit side, and they will go down on the credit side. Now that is one thing you need to remember. If you know this, it will make life a lot easier. Where will I place all balances? All balances will be on the plus side, so it will be shown on the debit side. Let's continue with the next lot. Liabilities, normally stuff that I owe. I owe a third party, I can owe a bank, I can owe a creditor. All of those items are owed. Now remember, liabilities are opposite than assets, minus, plus. So they will go up on the credit side, and liabilities will go down on the debit side. Now, as liabilities go up on the credit, your balances will be shown on the credit side, because liabilities go up on the credit side. And as you can see, it's the opposite than assets. But now we're going to the T accounts that confuses most grade 10s. So listen up, think carefully, and put yourself in the shoes of any sole trader's owner. So if you're the owner of a one-man show, if you're the owner of a one-man business, sole trader, what will you do if you have many expenses? What will you do if you have many incomes? So let's go and look at it. So firstly, owner's equity, you need to know overall is a minus plus. Now that's very, very important. Now remember, the owner will give money to start the business. So capital will be a minus plus, and therefore your balance will be always on the credit side, and capital will always go up on the credit side. When the owner takes money, it will be shown on the debit side. Now remember again, we have the columns for month, we have the day, we have details, we have folio, and we have amount. So that will stay fixed for all type of an accounts. So let's go further. Now, if capital goes up, as you can see, what influence will it have on my owner's equity? Your owner's equity will go up, and your owner will smile because they have more money invested in this business. But now let's look at drawings. Now, as drawings goes up on the debit side, drawings will go down on the credit side. What effect will this plus have on my owner's equity? It will have a negative effect. You see, owner's equity will go down. Although your drawings goes up, your owner's equity will go down, and that will give your owner a frown because he's losing some of his investment in this business. Now, remember, all of the accounts that we just covered will fall under the balance sheet section. Let's go and look at the nominal section now. So the nominal section will be all your income and expenses. Now, how will your income be affected? Income will also be minus plus. Now, let's stop here. Remember your incomes? We have sales, we have fee income, commission income, discounts received. So we're winning all the way, and we're making money for the owner within this business. Now, remember, all incomes in the end belongs to the owner. So as income goes up, what will happen to the owner? The owner will smile. And what effect will it have on owner's equity? Let's go and see. As you can see, the effect will be positive for owner's equity because owner's equity is going up because your income is going up. Now, if your income goes down, will you be happy? When you have less income this month than last month, say your salary decreased from where you're going to work one day, will you be happy if you earn a smaller salary from month to month? You won't be happy, just like the owner. If they generate more income, they have more investment in this business because they're creating wealth for themselves within the business. Now, very lastly, your expenses. Your expenses will be plus minus. Now, why will it be plus minus? Because as your expense, like cost of sales, advertising, water and electricity goes up on the debit side, what will happen? You will have a negative effect on the owner. So let's go and look at owner's equity again. As you can see, the owner's equity will go down. Your owner will have a frown because they are losing money, because they need to now use all the income they're generating to pay for their expenses. But now, I have a small little abbreviation you can use to try and remember what different things will be debited, what will be credited, and then remember what is good and what is bad for the owner. What's good for the owner is more capital and more income. What is bad for the owner? When he draws and draws and draws, and then your expenses if they go up. Now, the abbreviation I want to leave you with is debt click. So what does debt mean firstly? Debt means debit. What are we going to debit? We're going to debit expenses, assets, and drawings. And then I have click. What does click mean? Click means credit, liabilities, income, and capital. So I'll say it again. Debt means debit, expenses, assets, and drawings. And click means credit, liabilities, income, and capital. Now, I have a short question for you. Let's see if you can remember. Draw a flow chart to show the accounting cycle. Now, grade 10s, all I want you to do is highlight the first big stages within the accounting cycle for me. I don't need any information. I just need to know what happens first, what happens after the first thing, second thing, third thing. Quickly draw it for me. I'm giving you a minute. Okay, guys, I hope you got it right. I'm going to quickly read it to you and then we're going to look at the slides. So the very, very first step is a transaction. Remember, we won't record anything if nothing takes place within the business. So the very first thing that takes place is a transaction. Someone comes into the shop, they take something from the shelf, go to the teller or cashier, and then exchanges money for the product. So that's the first step. The second step is you won't be happy just to leave, and you would like to require something from that cashier, and you would like a receipt or till slip. So what's your second step? That will be your source document. Now remember, there's thousands and thousands of source documents, daily or monthly. You will be struggling to find out if you made profits or losses with all these pieces of paper. So what do you do with all the source documents? You put it in a journal. So we already covered quite a few journals. We're going to look at them now. So that is your third step, your journal. And then the last one I wanted is you need to take all your journals to your ledger. So your general ledger, your creditors ledger, and then your debtors ledger. And what do I do after that? I can draw up a trial balance to see if everything is in balance and that I didn't leave anything out and make any mistakes. So let's go and look at a full accounting cycle quickly. So here it is, the accounting cycle. What's the first thing that happens? My transaction. And I just explained a transaction for you. I can explain another one. A debtor comes into the shop, swipes his account card. Because he's a debtor, he's got an account with us, takes the goods, and now the debtor owes money to this business. So what did we give in return? We gave him an invoice. So that is your transaction, and then we're going to jump in here and now say the second thing we're going to look at is a source document. And what source documents do we get? Can you remember them? We have a cash register tape or cash register roll. We have receipts. We have the check counterfoil. We have bank statements. We have a petty cash voucher. We have invoices. And remember, we will keep the duplicate invoice when we sell goods. But when we buy goods on credit, we will get the original invoice. And now lastly, you'll have your debit notes and your credit notes. I hope you can remember where to take these source documents to. Then we are looking at your journal. That's your third step. So your journals, and what journals do we have again? We have your cash receipts, we have cash payments, we looked at your petty cash, we looked at debtors journal, the creditors journal, the debtors allowance journal, and then lastly, your creditors allowance journal. And then next term, we're going to look at the general journal, the salary journal, and the wages journal. So you already completed 7 journals, guys. 7 journals are completed. You need to know them off by heart. Now, let's go to the next step. Step number 4 will be your ledgers. So what ledgers did we look at? Your general ledger, that is your main ledger. And this is where we're looking at the double entry rule. So we always have 2 accounts. We have a debit and we'll have a credit. And then what else? We will look at the 2 sections under the general ledger, the balance sheet section and the nominal section. And remember, on the balance sheet, we'll have your assets, we'll have your liabilities, your capital and your drawings. Nominal will always be income and expenses. And when we get to term 3, you will understand why we're breaking up the ledger into the 2 main sections. But let's look at the rest of the cycle. We have your debtors ledger. Remember, this is for the triple entry. Why triple entry? We have 2 accounts in your general ledger affected, and then 1 account in your debtors ledger affected when a debtor either buys or returns goods or pays or gets a discount. And the same thing with the creditors ledger. We'll have a triple entry. We'll have 2 entries in the general ledger and 1 entry in the creditors ledger whenever we as business buy or we return goods or we pay the creditor. And what happens after the ledgers? We said we need to do a trial balance to check that everything is fine and correct. And then lastly, what we'll do in the term 3. Term 3 will be about your year-end adjustments to compile your final accounts, end of term 2, and then we'll look at the statements in the end, your income statement and your balance sheet. And those are very important for your accounting progress from 10 to 11 to 12. But Let's quickly look at every transaction. Every transaction will have the big 5. And what do I refer to here? I will say every transaction will always have a day that it took place on. We'll have a document number. We'll have a who we paid, who paid us, who bought from us on credit, who returned goods to the business. And everything in accounting will have a certain value. So that will be number 4, your amount. What amount did we pay? What amount did we receive? What amount did we sell on credit? What amount did we buy on credit? For example, and then lastly, the what or the why. What did we buy? Why did we sell? Who paid us and what reason did we have for this person paying us? So it will always be the big 5. And if you go and read through the transaction and you identify all these things, you will be fine in analyzing the transaction, posting it to the journal, and then if you remember the debt click, you can post it to the general ledger. Now guys, we will continue with the analysis of transactions and your journals after the break. See you soon. Okay guys, let's look at a nice breakdown. So you can copy this in a workbook, and this will definitely help you with your studies. So let's go and look at all the journals, all the source documents, and let's look at the major accounts affected in each and every journal. So let's go and see. I have the 3 columns. I have source document here, I have a journal, and I have the general ledger. Now remember, when you have the duplicate receipt, or the cash register tape, or the cash register roll, what journal will I use? I hope you get this. It will be your CRJ. And what account will always be debited? Bank will be debited. Why will bank be debited? Because the business is receiving money. And why are we receiving money? Because we had capital contributions from the owner, we had maybe more sales, the debtors paid me, we had fee income, or we had interest income. Now let's look at the next one. We have a check counterfoil. Do you know how to identify the journal when we have a check counterfoil? I hope you have it. It will be your CPJ. And your CPJ will be used to pay all your expenses for the month, to buy assets, and for the owner to draw a bit of money. Now, what happens to bank in this regard? Bank will go down, and bank is an asset, so assets will go down on the credit side. Now, let's look at the next one, petty cash vouchers. Petty cash vouchers, the journal will use your petty cash journal. And guys, the petty cash journal is so easy. It's exactly the same as the CPJ. It's again a payments journal. But remember, the petty cash journal is used when we have small payments. So we keep a bit of cash within the business, on the business premises, and we will use this cash to buy the small things we need daily or weekly. And now remember, what account will go down? What are we using? We're using petty cash. Petty cash and asset. The asset is going down. The asset is going down on the credit side. And as you can see, petty cash will then be credited. Let's go look at now the credit sales. I'm telling you, we have a journal called the DJ. So we have the DJ here. Can you identify the source document? I hope so. We'll have the duplicate invoice. And what 2 accounts? Remember, we have 2 columns. We have a sales column and a cost of sales column. What 2 accounts will be debited? Let's check it out. Your debtors control, because they owe you more. So therefore the asset, this is an asset, debtors control is going up on the debit side, but cost of sales will go down. No, it will go up on the debit side, but remember, it's got a negative effect on owner's equity. So therefore, owner's equity goes down, but cost of sales goes up because it's an expense. And remember, debit expenses. Now let's go and look at the next one. I have given you a DJ. Here's my DAJ. What source document will I use in the DAJ? Hope you identified it correctly. It will be a credit note. Now remember, when the debtor returns, they owe less. So we are crediting the debtor's account. So if we credit the debtor's account, we need a credit note. And with a credit note for the debtor, it means that they returned the goods to the business. They don't owe us anymore. They owe you or the business less. Let's continue with the next two. I gave you the CJ. Can you remember and identify the source document? It will be the original invoice. Now, I showed that expenses and assets bought will be debited. Now, what will be credited? Yes, creditors control will be credited. And why do we credit creditors control? Creditors control is a liability. If we buy more and more and more, it will go up, and therefore, as you can see, we credit creditors control. Now, the next one is CAJ. What do we need? We will have a debit note. What happens? When we return goods to the creditor, we owe them less. So if we owe less to a creditor, we will owe them less on the debit side. So therefore, I need a debit note. And with a debit note, it will show that you return the goods, you don't have it anymore, you return the stationery, you don't have it anymore. So therefore, you have less of those items, and those items will be credited. But what account will be then debited? Let's look at it. Your creditors control will be debited, and I can show you here why is that one debited? Because we owe less, we returned goods. Now, I'm going to quickly give you a nice question to think about. I'm going to give you a minute to answer it, and the question is, why will businesses sell goods on credit? 1 minute. Okay, guys, so why will businesses sell on credit? Now, remember, when we sell on credit, it's quite difficult to get the money back from the debtor. Some debtors will run away, some debtors won't pay you at all, they won't worry in paying the business back. So why do you think businesses will still allow people to buy on credit and leave with the products and then trust them that they hopefully will pay the business in the near future? Very number one, firstly, they can sell more goods. So businesses will be able to sell more. Think of most clothing stores in South Africa. Most of them allow people to have accounts with them. And with these accounts, these clothing shops stimulate actually excess of sales. People will buy goods they don't really need. They have the credit, so why not buy? Maybe they don't have cash during the middle of the month. What happens now? People will still be able to buy. So businesses sell more. And then another one, we create loyalty. What loyalty will be created? Now think of this. You have a certain account at a certain store. Now, if you only have an account at that store, where will you most likely buy all the time? You will go to that shop back and back and back again to buy more and more and more. And the more you buy from them, they're creating like a loyal customer. So therefore, businesses will always sell on credit if they have the means to, and they have ways to trace debtors and get them to pay them back. Now, let's jump in with a few transactions and let's analyze them in our accounting equation. So let's go and look at the first one. The very first one reads, you bought a vehicle and you paid by check 250,000. Now, what I want you to do is I want you to write down in your workbook what journal I'll use, what account is debited, what account will be credited, what will happen to assets, owner's equity, or liabilities if they are affected. I'm giving you 1 minute to complete this one. Okay, guys, let's look at it. So we bought a vehicle and we used a check. So let's go and look at it. Easy, we bought. So what did we buy? A vehicle. We have the amount of 250 and we used a check. So that is your bank. So let's go and see. Your bank will go down because we are using the CPJ. Your account debited. Your vehicles, we have more vehicles. So vehicles and asset will be debited. We have more assets, but also bank is an asset and we are losing assets. So therefore, both of these accounts will be assets. So we can't touch owner's equity or liabilities. And remember, your equation states that assets equals owner's equity plus liabilities. So we'll have plus minus 250,000. I hope you got that one right. Let's go and look at the next one. Issue a receipt for rent received. So we're receiving 5,000 Rand, giving you a minute to complete it. Minute. Okay, guys, so there's one word giving it away. A receipt is issued. A receipt. So we are receiving money. Where do we put the money? We'll put it in the bank account. So let's go and look at the wording again. We have a receipt here. So we're receiving, why are we receiving? We're receiving rent. And we're receiving a total of 5,000. So where will I put it? Easy. CRJ, Receipts Journal. Now remember, we're receiving money. Where will we put this money? We'll put it in the bank, and bank is an asset, and the asset will go up on the debit side. But now, why are we receiving money? We receive it due to rent, and it's an income to us, so we'll write it as rent income. Now remember, bank is your asset. So when bank is your asset, we'll have to go to your asset column, and it will go up because bank is debited. Now income also goes up because we're receiving more for rent income, and therefore we'll go to owner's equity. And as you can see, this rent income is good for my owner, and there we didn't touch your owner's liabilities. Now remember, always to look at it like this. It needs to equal. Is the plus 250 minus the 250 equaling 0 plus 0? Yes. Is the 5,000 plus equaling the plus 5,000 on that side? Yes. Let's go and look at the third one. You're buying packing material and you pay by petty cash. You're using petty cash to buy packing material. 1 minute to complete it. Okay, guys, so you use petty cash now. So if you use petty cash, your petty cash is going down because you're using it. Petty cash an asset. Now, what journal did I use? Very nicely, your petty cash journal. And let's go and see, what did I buy? I bought packing material. Packing material I bought more of. It's an expense. I have petty cash going down, which is an asset. So remember, your assets go down with petty cash, and it needs to equal now. Remember, assets equals owner's equity plus liabilities, and packing material is an expense. And the more expenses we have, the less owner's equity. Now I want to give you the very last one for today. Credit card sales, 6,000. Your markup is 100%. I'm giving you 1 minute to complete it. So guys, credit card sales exactly the same as cash sales. Now remember, when we sell for cash, we need to use the CRJ. We'll place the money in the bank. And why? Because we had a sale. What will happen? Your assets will go up because we debited bank, and your sales will go up. And as you can see, +6 equals +6. And then remember, when we have sales, we'll always have a cost of sales. And the cost of sales is married to trading stock because that's what we've sold. Now remember, you used 100% markup, so you can divide by 2, and then you'll get -3, your cost of sales and expense, trading stock, also -3. Guys, I trust you enjoyed the lesson, and I hope to see you soon. Good luck. Bye-bye.